If we start off by looking at capital allowances has very few changes. The annual investment allowance remains at £200,000, but you do just need to watch that they've reduced once again the CO2 emission level at which you get tax relief on your capital spend from 130 grams per kilometre to 110. That's as part of the continued drive by the government to reduce the CO2 emissions and to have a positive impact on our air quality. First year allowances continue to be available. There's some new stuff in there this year for electric charging points for electric vehicles, and also the zero emission goods vehicles are now being extended through to 2021. They were due to cease in 2018, and you can still surrender losses which are created from water or energy efficient plant for tax credit relief in some circumstances, and that relief continues. Keeping on the theme of cars, benefits in kind, again, there's some increases here to reflect the CO2 headlines, I think, really. So diesel vehicles increase from 3 to 4%, and there was some new tests about whether a diesel vehicle qualifies as a low emission vehicle or otherwise under the RDE2 standards, which is a road test rather than a factory test, I think, to try and make sure that the car manufacturers are sticking to the published CO2 emissions. Car fuel benefit goes up in line with the RPI. Benefits in kind, if you provide electricity to charge your employees' cars, then the employee doesn't pay tax on them. It's not a benefit in kind. Nothing arises in that respect. And the annual benefit for vans and van fuel goes up slightly, again in accordance with RPI. HMRC want to explore improved guidance on expenses and the claim process, and they're going to be trying to do this and put this online and make it all digital. So I think there's some good opportunities there, but we'll have to wait and see quite how that works out. And also subsistence payments at the end there, I would mention, where you're using benchmarked scale rates, and where these are paid, you no longer need to check that the employees have receipts. You just need to check that they've incurred qualifying trips and journeys, rather than look at the expenditure itself. So a simplification, that's much better. Moving on to corporation tax rates, again, the government continue to try to encourage and attract investment enterprise into the UK. No changes this year. A reminder, the 17% will be with us in 2020. There's been no U-turn in that respect. Corporate interest restriction. This applies to very large groups, and I think the headline there is the fourth bullet point that talks about every company or group will be able to have at least a £2 million interest expense without these rules kick in, but thereafter there's the whole idea behind this is to restrict the ability of very large groups of companies in business in the UK to reduce their taxable profits here in the UK through excessive UK interest rates. It's aimed at the Googles and the Amazons of the world. So the government alignments of the taxable profits with the location of the economic benefits really arise. Research and development, some changes here, a further 2.3 billion invested and made available, but that's in respect of the large scheme. So the large company scheme gets the benefit this year. The SME scheme is unchanged, and a company falls to be an SME if it has less than 500 employees, turnover of under 100 million euros, or a balance sheet under 86 million euros. Continuing to try and drive R&D and innovation in the UK, we fall behind our G7 peers on the percentage of our GDP spend. We spend 1.7%, Germany some 2.8%, Japan up to 3.5%, France 2.2%, and only Italy is below at 1.3%. Loss relief, these rules came in last year, but actually they've only just been formally introduced because as a result of the election last year, the Finance Act number 2 was actually pushed back to much later in the summer and into the autumn than we originally anticipated. But those rules are here, more flexibility, being able to carry forward losses against wider types of income and income streams, and also be able to group relief going forward rather than just in the current year. So there's some welcome changes. A change announced yesterday is in respect of indexation allowance. So where a company sells an asset, historically it's had indexation allowance on the base cost. So that inflates that base cost for RPI. That RPI increase now disappears with effect from the 1st of January 2018. And actually, for personal gains, indexation disappeared back in 1998. So I'm not surprised. I suppose RPI has been very low recently and maybe hasn't been on the agenda quite so much. There's quite a lot on the next slide in respect of other issues. The only one I really wanted to mention really was the consultation on intangible fixed asset regime. We've had the tax rules on our intangible fixed assets have been with us for about 15 years and remained relatively unchanged. And HMRC have now said that they want to have a look at those and check that they're fit for purpose and doing what they're meant to do. So I think we're likely to see some changes announced sometime next year. Looking now to spotlight on avoidance and evasion. Again, this continues very heavily to feature in the budget. The tax gap, you'll see, was 34 billion last year. The tax gap is what HMRC have calculated that needs to be collected compared to what they actually collect. 34 billion is still outstanding from UK taxpayers in 15-16, but that is down from the previous year. They are making progress. They've reduced it by a further 0.5% in 1 year alone. So there is a spotlight there, certainly, in that respect. 160 billion recovered since 2010 by tackling avoidance and evasion. Withholding tax on royalty payments, where large corporates have tended to pay royalty payments to low tax jurisdictions to avoid UK taxation. They're now going to introduce withholding tax to make sure that the UK tax gets its correct proportion of the tax arising on those. And also the hidden economy. Some people will find it very difficult to get licenses relating to their trade and their business unless they're properly registered, to make sure the spotlight on avoidance and evasion continues. And actually an extension of this theme really is the Making Tax Digital theme. I'm not going to go into that in detail today because I'm conscious of time, but what it does demonstrate that the whole idea of reporting more regularly to HMRC gives them more information. More information means they're going to have more knowledge about you, your business and your affairs. And I think it's fair to say that the revenue computer system that they're building and is growing in its complexity and its efficiency is a very powerful tool. And I think we mustn't underestimate just what the future might look like. Just a quick refresh there, that over the summer the deadlines for Making Tax Digital were extended after lobbying from the Chartered Institute of Taxation. So we do have a little bit more breathing space, but I think it's fair to say, personally, I think that they won't be extended any further. I think they will be going live on these dates, chaos or otherwise. You will need to make sure that you have proper software to do your Making Tax digital declarations, and cloud accounting will be the best way to be doing that without doubt. SB Live, our cloud accounting software, will interact very well with MTD, and I really do think that people need to be thinking now about moving on to platforms that interact with HMRC. HMRC are not providing any software whatsoever free to anybody. So people will have to get it from other people, from third parties. That just leaves me to say thank you and close for today.